Good morning, everyone.
Good morning.
Today we're going to, in Controller's Corner, we got two segments. They're both going to involve the E.CLIPSE module, which is inventory valuation. The first segment is a question that comes up quite often when on the feeding inventory valuation, why there's always a variance when close out a group of animals. And we're going to look through and analyze and figure out why this variance occurred. We're going to look at two reports to do this analysis. We're going to look at the Accounting User-Defined Report, which is under Reports, General, Accounting Detail Reports, and then User-Defined. And the second report is in the inventory valuation. It's a WIP current detail report, and it's under Setup, Feeding, Inventory Valuation. The top box is current detail. So the user-defined report, we're going to run it for the date range for that group of animals, which this example is October 1st to May 31st, and we're going to limit it to the center that we know that these animals are in to get accounting data that's related to that group. So the resulting report, I can't read a lot of the numbers, but off to the far right, we have a column for the group of animals. So what I did with this data is we ran it for a period of time for one center, but there may be other groups of animals that started or finished in that same center. So we filtered the data down to just the transactions that are related to this particular group that we're going to look at. Then under the current detail report, this is what I mentioned. It's the top right-hand button, current detail. We're going to run it for the same period of time, October 1st to May 31st, and for the same center, 40/20. This is going to give us all our WIP transactions that posted for this date range in this center. So the resulting report, this is an export into Excel of the data for the WIP transactions, and it gives you a summary here at the bottom of all your revenue and all of your costs. And it gives you a period variance of 15,530. So this is saying that we closed out this group of animals. We still had a variance of $15,000. It could be related to this number here, the profit and loss. The profit and loss is actually a FBS calculation. It knows what your sale amount was from the deposit you posted for the sale. And it knows what your costs were because it's whipping those costs every month and assessing a value per animal. So when you make a sale, it knows what to calculate for the gross profit. But in reality, your profit or loss on this group of animals is $176,000 minus this variance of $15,000. That's your actual net income. And I want to kind of qualify that a little bit too. That would be your gross profit on this group of animals if all the costs were in here whipping properly, which we're going to find out they're not. So just a real quick recap. It shows revenue $472,000. That's all based on deposits that you posted to the group of animals through your accounting entries. The profit and loss is a calculation by FBS. Then we had 11,000 of animals that transferred out, and then 16,000 for that same transfer for costs in the prior stage. Those are computed by FBS also. Then period feed of 147,000. That would be your total feed invoices or feeding transactions posted in Smart Feeder for that period of time. Period expense, 86,000. That is your accounting entries for facility costs, labor, some of those other costs. That's what the 86,000 represents. And then external move-in, that would be animals moving in from another stage. That was the cost calculated by FBS of those animals on inbound. And then you get down to your total expenses and your variance. So we started looking at all the accounting transactions and compared them to the WIP detail report. We have a sale right here on 11/12 for $22,000. That sale should be on our WIP detail report, which it is. Very first line, 11/12, $22,000 has your annual quantity of 187, which matches the 187 here. So, okay, the accounting transaction was posted. It also got WIP, so we know that's tied together. But let's look at the next sale right below that on the same date, 11/12, same ledger account, 30171, for $10,000, 120 animals. We don't have any other sales on our WIP report for that date. How's that even possible? How's it possible that when you ran your WIP, you had a sale on 11/12 for $22,000, but you also had another sale on the same day that didn't show up at all? And what's happened here is the WIP was calculated, then someone in the office posted another sale to that same date after the WIP was calculated. The person who does the WIP calculation was never informed that happened. They move on to the next month, and that sale just sits out there. It's not part of your inventory valuation anymore. What it should have done, it should have recorded that sale and reduced the amount of your balance sheet by that sale amount, and pulled those costs off your balance sheet and put them back on the income statement. So right now that sale's recorded on your general ledger properly, but your WIP is, your inventory value is actually overstated because of that. This first transaction on 10/29 was two animal health supply invoices, one for $935, one for $28. Where's that? Our first transactions started at 11:30. This will be at the top of the detail report under the accounting entries. There's no entry for 10/29. So what's happened here is an invoice for animal health was posted to this group of animals, but the WIP was not calculated, or once again, the inventory was calculated and those invoices were posted after the fact, and the WIP was not recalculated. So we're starting to see some odd transactions, some strange variances going on here. When you get down to this section here, it says SF automatic allocation. That is a smart feeder allocation journal entry, and the center is S for the S is their designation for a shadow account. So S0400 processing fee $489. We happen to see that on 11/30 that it whipped that same dollar amount. Then this other line right below it here on 11/30, finishing facility costs, SF 300 for $48.58. And there we find it being whipped, finishing facility cost $48.58. We're good. That's working properly. Let's look at the two items that are highlighted. Same day, this is a cost allocation, S0100 and S0230, finishing labor and a general port shadow entry. One's for $556 and others at $834. On 11/30, there's nothing. We've got the two we already identified, and we've got some trucking costs that got whipped. So what that's telling us right there is that the cost allocation is allocating costs to that group of pigs, but it's not being whipped at all. So we have to go check and find out on our bridge whether this is whipping properly. But and I did highlight, I don't think there's anything down here that's important. So anyway, this is a quick analysis of the first transactions for October, November, December. We already see some issues with our WIP. So we've identified some differences, and we need to verify whether the bridge is set up properly. So to edit your bridge, you go to Setup, Feeding, Inventory Evaluation, and then Set Up Bridge. When you click on that, you're going to get your bridge. We're looking at the Expense tab for this particular act. We know we have some shadow accounts that aren't whipping. We need to go take a look at it. And we look through our ledger accounts that we have set up to whip. We do have SF300 for our shadow and SF200, but we don't have SF0100 and SF0230. So in order to fix that, we would need to add 2 more lines to include that labor charge and that general port charge in our bridge, so it whips. So I went ahead and added those 2 shadow accounts to my expense tab on my bridge, and I said I'm going to go back to October and I'm going to recalculate my WIP for the whole period of time. Totally different results now. My revenue went from $472,000 to $482,000. That's exactly what we expected to happen, because we saw that we were missing a $10,000 sale when we looked at our original WIP. The profit loss went from 176 down to 149,000. Our cost of transfer pigs, the prior stage stayed the same, and the current stage actually went up a little bit, which makes sense because we had expenses that weren't being whipped. So when we whipped them, the cost per animal went up. Our period expense, 98,000, I believe it was 964, went up some due to those 2 shadow accounts that weren't whipping. And our external move-in now is 107,000 versus 104. So all in all, we went from a negative 15,000 to a positive $2,982. So once again, our actual profit on this group of animals was 149,000 plus the 2,982, which was approximately a $10,000 variance in our inventory valuation of one group of animals for that period of time, just because the WIP wasn't set up properly, or things were being posted and not being whipped after they were posted. So one of the things that we covered when we discovered some of the problems that we were having with the animals, the cost of animals, fairly large operation, and due to the variance we found on one group of animals and multiplied by all the groups of animals that are in the process, it becomes a very large number. We talked about setting up what we call a closing periods module. It allows you to close periods and lock people out from posting transactions. So our game plan going forward is to implement the closing period module, set a period or set a time during the month to close the month, and the month is closed. If something truly does need to be posted back to a period that's closed, they need to go to the controller or office manager and ask that that period be opened up, and then you can start asking questions like, why do we need it open? Well, I got this invoice for feed. How come that invoice for feed is so late? You can start kind of getting into some of the issues of why transactions are so late getting posted to the system. I think it's a great way for them to establish some control, because as a person that's opening the period back up and posts an invoice, it's also a trigger to tell you, hey, we also need to recalculate WIP for this month because we just changed our inventory values by posting this transaction. So the closing module is, this is, when you click on input, general, you get this screen right here. But you won't see this down here, open periods. And you can change the periods, or when you click the change period button, you get this window here pops up. And you have total control over what periods are open and closed. It could be 2 months, you have 2 periods that can be open at the same time, and that's it. But the length of those periods can be anything you want. It could be 2 months, it could be 6 months. They were asking since the animals is 6 months approximately, can they leave 6 months open at a time? I said, absolutely not. That's gonna cause the same problems you're having right now. We need to really restrict the periods. So maybe your 2 periods are, for like now, it'd be June and July and August, and you could have June and July combined into one period, and August as another, and then you'd have to shift it, next week when September starts up. But those periods that you have open, you have total control over the range. It could be 1 month, several months. My recommendation is not to get too wild. Otherwise, what's the point of having closed periods if you can't restrict them? So, I believe that's it for that. Questions, concerns? Did I go too fast?
You set up a schedule when you recalculate. I mean, you do it once a week, or to try to avoid missing somebody coming in late.
As far as the recalculation of WIP, I like to do it once a month. Sometimes I do it during the month just to get an idea of what the financials look like. But really, most analysis takes place at some juncture the following month. So if you're looking at July, by August 15th, all my invoices should be posted, and I should be able to calculate my WIP. And if you're doing electronic feed invoices and they come in within a couple of days, I'd say by the 5th of the month, you should be able to calculate the WIP and take a good look at it and see how everything's going through. But the last thing I do before I move on to another month is recalculate the WIP again, even though maybe nothing's changed, because that's just a little security that we capture anything that may have come in after the fact. But I do like to close periods, give you that control, and it gets your office staff kind of in line too. That we got to be timely on these things. We can't just wait and all of a sudden just post something later on, because it does have an effect. And this example was we had a $18,000 swing in our balance sheet, but that's just one group. So you multiply that, it becomes a larger number, and then it goes back to, I think, a lot of the things we've been talking about the last 2 days is I want to produce reports out of FBS that are meaningful and have value. And if our numbers aren't what they should be, then you always have that doubt that things are right. And that's the direction we're going with this particular client. Is we're gonna close the periods down. We're gonna lock things up a little bit. We're gonna tighten up control, and we're gonna get our balance sheet and our income statement in line. So when we do hand these to management, that they're meaningful and they're correct, and not, well, this is kind of where I'm at right now. I mean, nobody wants to hear that or deal with that. So the long answer to your question is I do once a month calculate and really dig into things, but there's no reason why a person couldn't calculate once a week.
But then you could run those 2 reports, and that's how you check yourself.
Yep. I think that
you would want to do it more frequently than once a month if you're doing group closeouts and allocations. Your allocations are floating through.
Yeah.
But the point is that handles you get the values in the middle of the time period for closeout, which is okay, but the balance sheet is updated, the WIP adjustments are made at the last day of the month.
Right.
So you wouldn't really have anything, you won't have a balance sheet in the middle of the month. You have to set it at the end of the month.
And I calculate during the month just to see what the income statement fluctuates by. I don't do this analysis then, but when you sell animals, all that revenue gets posted right off the bat, but the expense relief is still in WIP. So you look at your income statement, it looks pretty good. Well, then you recalculate the WIP, and those expenses get pulled back off the balance sheet and onto your income statement. You get another, like Norm said, you don't have the full picture, you don't have those month-end entries, but you do have the adjustments for those sales that took place. So it gives me a better feel where the month's at, net income-wise, especially in a lot of sales the first part of the month. Just gives me a better feel.
I think, our experience with Mike sharing, that's how it happens in the beginning. But then after that, you've got it all set up. You don't find these errors unless you're adding a new account or something, right? I mean,
Exactly.
once you get it, those errors don't happen. Once you settle it out, you've got it all set up how you like it.
Right. And that's exactly what we're going through right now is we're breaking things down into smaller pieces so they can understand what's happening and we can fix these things. And if we can stop entries being posted after WIP's been processed and we can make sure that the bridge is set up properly and our costs are allocating the way we expect them to, then you're right. They're basically pushing a button. And that's where when I get to that point, it's comfortable. Then I can calculate it anytime I want, take a look at things, and I know that things are fine.
Where we look like your cattle, as you first sell off the first couple of loads, you can run the WIP and you kind of have a margin of, okay, where are these coming in and where I thought they were.
Right.
You've always sold off a couple of loads. So
Right.
you'll bring an appropriate WIP charge to get those horses. Like in the middle of the race, it's up to your balance sheet and says there's a right number, but we're getting a sense of how this.
And that's, if you think about that, you fire that up, it goes out and deletes all these entries, and then it creates a whole bunch more journal entries, and do that all day long. Just keep deleting, recreating, so it doesn't hurt anything. Just keep doing it, and it creates thousands of these entries.
And the questions come up before, is there an audit trail of what's going on with WIP? And the answer is no. As Norm said, it deletes all those entries and reposts brand new entries. So there is no audit trail of what's been going on with WIP. It's only what the last calculation was. You're only audit trail for WIP transactions.
Yeah, unless you save copies of the export copies of the inventory valuation detail.
Right.
That's the work papers. You can copy that to Excel and have that as true as a backup. So one of the things I think, looking at that source, that error, most likely it wasn't that they didn't post that sale. They probably said it posted the wrong group. I guess there'd probably be another group that showed the variance going the other way. And if they were balancing their checkbook and they had some balancing of the inventory, so it just had somebody discovered that, hey, I made the wrong group, and they went in and changed it. So it broke two of them at the same time.
Right.
And so it's unlikely that it wasn't done at all because it would get the journal ledger. If it was a death loss, yeah, they most sneak those in without anybody knowing about it. And that'll break the divisor on it.
Closed periods would stop them from going in and changing that.
I'd love to do that.
Any other questions? All right. So Monday we had a data mining workshop, and a lot of discussion about feeding cost analysis, crop cost analysis, the consolidated cost analysis that Norm refers to as the BEAST. I thought I'd go through an example of a good set of data that shows how one entity set up their different cost analysis and how everything ties together. First thing we're going to run is we're going to run just a plain old income statement, and we're going to report definition. It's just going to be zero, all ledger accounts, nothing fancy, just a basic income statement.
There.
There it is. Wow, that's small.
Okay, yeah, change the resolution all of a sudden. Well, let's see what. That makes a difference. Yeah, that's better. That's it.
So trust me, we'll go back. Kind of hard for me to see. Basic income statement. Total income, $98,368. Remember that number. Because probably won't be able to see the next slide either.
You can see it there. Scroll
Yeah.
down there.
$98,366. Yeah, I can see them on there on this. There we go. So the next report we're going to run is the consolidated cost analysis. It's under accounting other reports, and it's as we discussed on Monday. It's not a canned report that's just part of your general reports to come with that. You have to something you're going to design from scratch. So to get to that, set up accounting, then you're going to pick consolidated cost analysis. It's going to give you when you select that, it's going to ask you if you want to build from scratch or do you want to build it from ledger accounts. And I always build from ledger accounts, and Sarah always build from scratch. But what I ended up doing was build from ledger accounts and deleting stuff I don't want, and she just prefers to build it based on what she wants to see. And all the columns in that report are by center. So when you go to set up accounting consolidated cost analysis, you're going to get this window right here, and it's going to say first definition, which is just I call it a placeholder. There's nothing really there, but it holds that report. So you're going to say that you want to add a new definition, and then go to the next line and call it test or call it whatever you want to call it. Give it a name, and you just click OK. When you do that, like I said, I picked build the ledger accounts. It's going to give you this screen here. It's going to have all your ledger accounts and what the account ranges that you're going to set up for each of these different lines in your cost analysis. You go ahead, in the center of the screen, there's a button called Column Maps. Go ahead and click that. You get this window. And once again, you're going to have to click Add and create a new column mapping definition that you want to set up. Once you click Add and give it a name, you're going to get this window here, and you're going to define what you want as your different columns on the consolidated cost analysis. This particular example, it's got the finisher costs under the first column, the nurseries under the second, reading under the third, and then we get into some other centers that are part of the cost allocations to the first three centers. Everybody on board with that? So we're going to run a consolidated cost analysis, and we're just going to run it. We're just going to run it for 1 month. This is for the month of January. So the most important piece is your date range, and then you're going to pick your report definition, which this example is called master, and the column mapping is just standard crop feeding, which was what was on the prior screen. So we see that same, we got finishers here, if I can't see any of it from where you're at. We've got finishers, nurseries, breeding, pork profit center, servicemen labor, load crews, transportation, other facility centers, and unallocated. We've got a profit and loss statement for each one of those. And let's go with the profit here. I wish I could make that a little bigger, but I can advance with this. Can you make that? Yeah, it's a little bit better, absolutely. So what we have, $98,366. That matches exactly to our income statement. So we know that all of our revenue and expenses from our income statement has transitioned to our consolidated cost analysis. So, number one, this is where we want to get to. Number two, what is all this telling us? Well, our breeding herd shows a negative $9,500. Not bad. For me, I'd call that immaterial. But what it is telling us is that all those costs, except for $9,000, move to your nursery stage. If you had a lot more than that, I mean, I'm not sure what we would say would be material, maybe $20,000. We'd want to try to figure out why are our costs not moving with the animals from breeding to nursery? Because those costs shouldn't remain. They should be moving with the animals. Same applies to the nurseries. $1,170. Really good. So all but $1,100 are actually $1,100 more than your costs moved. So your nursery costs, we're seeing that our nursery costs are moving to finishers. Then finishers are sitting with $117,000 of profit, which is how we want the cost to flow. Now what are these other centers telling us? These centers all should be whipping and allocating costs to one of these three centers, depending on how they're set up. So labor and personnel, $9,800. And then right here we see the loading crew assignment, which would be your shadow cost allocation, $9,400. So not 100% of your load labor dollars have been whipped, but a majority of it left. There's still a little bit left there. I guess that. Same goes for servicemen. $26,000 of cost, and they whipped out $33,000. So they whipped out more than they needed to. These other ones are all. This one here is facility centers. They still got $4,000 whipped more than they did. And I know in this particular example that the pork profit center, why they're doing some of the things, why some of these dollars are down here. We don't need to get into that. The client knows why they're doing what they're doing here, but essentially, you want all these support centers to be whipping to your production, and this statement shows us that. Yes.
When you do the setup for Eclipse, are you using additional division of the automated postings or the same division?
Same division.
My recommendation, from my experience, has been once you do this, which is great for certain purposes, it's really hard to go back. And when you come up with some modifications, so let's say you're trying to get back to product production. If you related to online, because you've got all the automated postings placed in there, and the solution to that actually Dan come up with, and I worked with him on, was to use a separate division, which is an automated division. Now, Norm, do you have a problem with doing that?
I don't think so. The main thing would be consolidated across other.
Well, you can include it or not. If you include it, then you get all the WIP adjustments. If you don't include it, you can look at the data without it.
Yeah, I think that's probably a preferable way of going about doing things.
It gives you more versatility. Just go over either doing that or thinking about it.
So in the bridge for inventory valuation, one of the first lines it says your posting division, and what John's saying is you would set up an entirely separate division just to post all of your WIP entries to keep them isolated from your other transactions.
You're looking at an expense account. You're looking at something, and you look at it, and you see literally can be hundreds of automated postings. And you're trying to get back to the original cash transactions, original transactions. So if you set up, and I usually use like Division 0 for the standard, and Division 99 for everything, for the automated. So you just say, okay, let's just look at 0 or 1 or whatever that division is, and leave out the 99. And then you can see the pure, what was originally driven by transactions, not driven by the WIP calculations, which I always found helped a lot in figuring out what problems might be if there's something that's supposed to be in there.
But that would be particularly if you had manual journal entries at the accrual level. That's filling those out. Otherwise, you can see your cash transactions running cash.
Right.
Yeah, it gives an extra.
That's one,
That's a
different
feature
perspective.
It's a feature that's in there that I don't think hurts anything, and it gives you a little more flexibility.
We use that, and I like that because we do audited financial statements, and my auditors know nothing about what happens in Division 35, and they just see the accrual, inventory postings. The only time you do see some of that is when I have to do cost build-ups, because the allocations, I need to prove allocations going from center to center and emptying costs out. But like when they want to drill down of account detail on something, it's just significantly fewer entries around.
And thanks for mentioning it, Joe. That's where I've seen it. You get accounting professionals that know nothing about FBS. They get into that, they go, what the hell is going on? They don't have any clue how to follow that.
Right.
It's a very
And
easy
what-
advocating.
Who puts these entries in? They just happen automatically?
Oh, really?
That's a tough sell. I don't know. Call Norm.
Because when you set up E.CLIPSE, it's in the setup of E.CLIPSE
Bridge.
There's a choice where it says a division for posting.
Yeah. They'll say port posting division, and you'll have it set to whatever division.
I don't know, if you already were doing it one way, switching to doing it this way, is that like you had a cutoff and said, okay, anything from 2015 older is on without and forward. So you have a little trouble.
It's all that we control by reporting, so you can include it or not. But the only time I think would be, as I recall, setting up Sundays, you had two entities within the same data file. You had crops and you split one. And if we had one division posting that had crop and all WIP in it, so it was. But if you just set up the typical way we're doing it now with separate data file,
Which is a recommendation that we put together.
Yeah. Or yeah.
All right.
If you had two divisions, you had one division for raised hogs and one for purchase hogs, and the system's going to only post WIP to one of those two. It isn't going to go both of them. So
This works for multiple entities, right?
yeah.
You would do this process in separate files for different entities.
But you can run a consolidated cost analysis by across data points. You better make sure everything else is cleaned out on the individual data files before you do this, but yes, you can. You can do it.
So you can do consolidated cost analysis across multiple databases.
Which with your column mapping, you have different, which you obviously need a different center ranges for different entities. You can roll them up together. So, for example, you could have the same headings there: finishers, nurseries, and breeding sows, but they would roll up across different.
But that's assuming you're doing the consolidated, so you have standard chart accounts, you have
Right.
standard
Right.
centers, even though you don't use the same centers in each entity, your numbering system is unique to each center.
Yep. No duplicates. Yeah. Except for the ledger accounts. Yeah. And I guess just the margins we're showing here on the support centers. Is that expected? If it is, why are we seeing the margins there instead of getting 100% to the?
So the reason you're seeing under transportation, you've got $1,250 of actual, let's say, fuel costs, and they whipped $22.90. So they've got a standard cost of X dollars per mile driven or whatever they're using for their cost driver, but the cost accrual or allocation is greater than what their actual expenses were for the month. So, and I call that immaterial. There's no sense in messing with it every single month because it's going to fluctuate. The main thing is are we on target? If you keep seeing this variance every month, all this like I said, this is just a report for January. This is a variance for 1 month. This variance could just keep growing and growing and growing if you don't take a look at it and analyze your standard cost allocation and dial it in a little bit better. Or this has happened, fuel invoice should have been in January, got posted February 5th, and if that invoice was posted, it probably would have been on target. So if that particular example happened in February, you'd be back in line. But that's what this is showing here, is you whipped more dollars than you actually incurred, so your standard cost allocation is high for 1 month, which I don't find the need to.
Something's going on with servicemen. That seems to be a big jump there.
Yeah. That's what, $5,900, $5,800. And I know there's some costs being whipped that normally we would dial in only because they were trying to compensate for some other things, and they just decided to whip more dollars than. But they knowingly left the numbers the way they are. Like I said, these are immaterial, but I know the 20,000 they were doing some manipulation.
So if you're paying on a fixed base basis, why would you almost always see a variance on the monthly facility centers between what your standard cost is and what you pay? Pretty easy answer to think about. Well, that is good, yes. You're paying on a fixed base basis. You pay the same amount, most everybody pays the same amount every month.
Number of days a month.
Days a month, yeah. So that's why you don't want to get excited about that. That's we're accruing it much more accurate than what you're paying.
So good report. We're going to take a look at this number of 117, 157. That's our finisher profit and loss based on the consolidated cost analysis. So go back to the slides. Yeah. So this particular example, our consolidated cost analysis balanced, which is fantastic. But what if it doesn't match your income statement? How do you go about trying to figure out what the variance is? When you run your consolidated cost analysis, there's a button at the bottom that says CCA options. You go ahead and click that button, you get this window here. And you're going to go ahead and select CCA ledger comparison. It's going to compare your ledgers to your CCA setup. You're going to get a window, or you get a report that looks like this. So I can't read it, but I'm sure you can. The top of the report says CCA amount, then your ledger amount, and then a difference. And it's going to show a difference in that column all the way down to the bottom. It's going to compare net income from your ledger, which is $98,000. It's going to compare your net income from your CCA and tell you what the variance, but it's also going to tell you where it's off. So it gives you an idea where to start doing some research on your CCA setup to figure out what accounts are not mapped in that report. So the last report we transition to is going to be the feeding cost analysis. Once again, it's not a canned report. It's something you're going to have to build from scratch. You're going to build it in a similar fashion that you did the consolidated cost analysis. It's under setup, feeding, cost analysis. You go in there, you can build it from scratch. You can build it from ledger. And once again, the columns are by center. I'm not going to go into setup, so it's the same as the consolidated. So we're going to go ahead and run a feeding cost analysis for the same period of time, January to January 31st. We're going to pick our centers of all of our finishing centers. Then we're going to do a comparison, which is option 5. It's by column and centers by column. So we're going to get a finishing report with every single center in its own column with a P&L associated to it. And then the report definition is going to be the one that we built when we did our setup. Go ahead and click OK, run the report, and you're going to get a feeding cost analysis, which it says 117, 157. Matches perfectly to the consolidated cost analysis. So we know all our finishing costs are represented here. We have a profit and loss by every center for a snapshot in time. It's not by group. It's just a snapshot of January's transactions. It shows your profit and loss for that month for that particular center, and it matches. So we have complete detail to back up.
Mike?
Yeah.
I have done this a number of times for clients. This could be really powerful to evaluate different contract agreements. So, you've got different ages for different guys, for different bonds, or groups of bonds, and you can look at them, everybody on the same basis, in the same period, over the same period of time. Now, you do have the fact to fulfill those bonds at different times and so forth. So, the wider the range you can run it, the more confident you can be in the data, because you don't get seasonality. If you start something, one group of pigs started in January and the next group started in March, you're going to have different cost performances. So if you do that over 2 or 3 years, that seasonality effect of the starting dates of those groups would have much diminished. And I've had people do this then to go back and evaluate the relationships with them. These are contractors that are like labor, usually loans and bonds and so forth, to really evaluate that relationship when it comes to renewing leases and renewing contracts.
Right. Absolutely.
It's almost the only I have found really solid way. Usually you get that data all put together.
Right.
Very nice.
I use this report to submit information to AgriStats for benchmarking, because you can run this like closed group.
Yes.
So at the end of each month, after we get our books closed, I have to get reports to AgriStats, and I just run this report for closed groups, and it gives me all my groups, and then I run group closeouts that have the performance data, and that's the basis of my report for all the finishing stuff. It's 2 reports. Takes a few minutes for the reports to run, but you get all the information, and it's tied back to the income statement, so you know it's a good source of data. Otherwise, it would take a bunch of work through running user-defined reports and sorting and stuff to get to that breakout of info. And then whatever you have set up for your columns or whatever, I had to give AgriStats what those expenses are, or even, like, I have a name what matches what they like to see, so that's always on the left-hand side of the report for them. So that's where I get that info. The challenging part of that is we convert all of our information back to lean to finish, because most of our production's lean to finish, but we have a couple nurseries, and we run our nurseries different than anyone else. So we run 8-week terms through them, so they're giant nursery pigs coming out, so they don't fit AgriStats database. So I got to take the finisher group and the nursery group and combine them. Well, I can just run these for different periods to pick up their different nursery costs and then add them together. So it's really, really effective for them.
Anybody else? So I wanted to take a look at this feeding cost analysis and talk a little bit about what we're looking at. We're looking at a P&L for every center, but some of these aren't showing any profit, some are showing losses, some are showing profits. These groups here aren't showing any income. That's exactly what you want to see, because they're not selling any pigs. They're not selling any pigs. Our costs should be whipping, which we're seeing that whip entry here, whipping onto the balance sheet, and you shouldn't have any income for that group of pigs. It all should be on your balance sheet, work in process. The ones that you're starting to see some income or loss on have sales, which is starting to calculate whip, starting to generate your profit and loss on every sale. So this is exactly what we want to see. We got all this activity for pigs and feed, we have no profit. So it's telling us that our costs are going in, and we're getting our costs whipped back out to the balance sheet. And then as we sell pigs, we're seeing that expense relief going back to the income statement. We're starting to see some profit and loss showing up on our feeding cost analysis. One thing before we wrap up, I think I just got a couple minutes. On feeding cost analysis report, that was strictly in dollars, but I wanted to point out to everybody that you have the ability to display by per head, per hundredweight, and you'll see that up at the top as Norm says, toggle. So it's the same report. You don't have to regenerate the report. All you're doing is clicking this display button, and it's changing your description up here, and it's putting your dollars. It's changing this next screen. Actually, this screen here's got it in per head out, and then that was the last slide. I lost my. So I just want to let everybody know that you have the ability to take that data and display it in different things. Per head out, per head sold, per hundredweight, some of the, I think the 3 main ones as you follow through the data. But, that is Controller's Corner for 2016. Any other questions? That's a good dialogue. Yeah.
So on my, not on the feed, but on the CCA,
my fee never quite matches back to my income statement. And, I'm just curious, it's not material, so I don't worry about it. I'm just curious what might be causing that. What's triggering
Variance.
yeah. And that is
Is it, you have your own feed mill? Is this an entity that has your own feed mill?
we have on-farm mill and we also have three pulp mills.
But it's not, in other words, it's not pure toll mill.
No.
So it's not coming through to your, some of that feed is coming through, internally versus and that's something that, if you feed, you have to have a linked account. If you can't take a feed, the actual ledger value of the feed, on any kind of a linked account on that report. I like to add that so you would just ignore the internal entries and let's just look at the external entries. That's the challenge. You get your own feed mill, there's adjustments going against that feed. There's a lot of things going on.
I've never found a way to, and I haven't spent much time on it. There's not really a good way to reconcile that.
But you should be able to tie out on the individual production centers the feed costs. That should match all the way through. You're doing a column for the center for the feed mill, the unallocated part. That's the thing that is where any variance is going to occur. To be able to dig into that. We had one client who's, it's not the way we recommend doing it, but they had a big commercial feed mill, and that was in the same umbrella as a large production company, and then they were selling to another production company. So there was a lot of activity going through the feed mill. Like, you much better have that feed mill segregated by itself. You know how much was adjustments for the inventory on that.
So his small variance is probably due to the fact that there's not as many transactions going through that internal feed.
It'd be just the absorption variance in our internal feed mill that isn't, totally. But again, it's immaterial.
Right.
For what, as long as we know our ledger integrity is there, we don't need to be to zero. I mean, if we know what the cause is, it's nice to be to zero because then nobody asks questions. But as long as we know the cause and say, okay, it's that. We find here, when we were here, we were wondering whether we wanted this. We're very glad we have these ones. I mean, it is powerful. It's challenging maybe at first to get your head wrapped around all the entries, but we want to go back.
It's very powerful in a good way and a bad way. It's very powerful if things are wrong to just keep running the wrong direction and making things even worse as you go. I've seen where E.CLIPSE inventory evaluation is just a click of the button every month and no real analysis. And then they ask what's going on. You start looking at it and you see these huge variances between what the real costs were and what they've been allocating. And it's a train running off the tracks. So you've got to run that standard cost vendor model report and take a look at your actual costs compared to your accrued costs and see how they're matching up. If you're close, like I said, if it's not material, I move on. If I see it trending the wrong direction, I got to make an adjustment to my standard cost to dial it back in a little bit and make some small tweaks. But what Norman and I are talking about is by me doing that, I lose my ability to go back and recalculate the width for the whole year because I've been tweaking the standard costs as I went along. And if I go back and recalculate, I got to know what the standard cost was for each of those periods. So essentially to do that, I have to run a standard cost report for every month, look at what I charged for my standard cost amount per head, and replicate that going forward, which makes it difficult.
And Joe, you're doing that, aren't you? Changing standards every month.
Yep. I allocate everything out every month.
Okay.
You go 100%. Yep.
Correct.
You don't go back.
You can't go back.
Yeah, and we use the standard coming out of our south farm saying this, and we're in startup, and then, and we even did it in the past, and then the south farm operator, like, you gotta get to break even here. You know, so we're not passing that in our startup now, that increased cost that they downstream to nursery finisher.
Right.
So those profits are based on, hey, if this pig was at this price, and it keeps, so there's, but that's the other side of why you might want to keep the standard. I mean, we're okay showing a loss right now in our salary. Right.
You know why?
Yeah.
Well, that's a transfer value, right? So you're assigning a transfer value to
Right.
pigs.
Right.
We do the same thing. We have a standard number that passes through, but then we have to do I have to do a true up entry for our accounting firm because we can't create. They don't accept creating or manipulating when profit is taken. They want it to look like it's all taken at the end. But we do a transfer value, and then you can see if the sow farm is plus or minus that kind of target number.
I guess we only do it once a year. I mean, as far as like our family we did some remodeling in March. I mean, it was $100,000 to remodel. Wow. If we throw that out every month, then our bill expenses go high that month, right? But now I go to so you don't go back and recalculate that month at all.
No.
I guess. I mean, I guess what we do is I base the rate at the end of the year, and then I zero it out.
So, but that's what you're going to do. So you build all your other systems around that.
Yeah.
My systems are all built toward I want to allocate everything out every month because we have too many things change in our production system. We are very flexible on what we use accents and buildings and stuff. But I kind of need to just say this is it, or I'm going to look back at you can go, what the hell even happened? What do I do?
Well,
What do
I
I do
think
now?
the key thing is you need to be consistent with what you're trying to get to.
Right.
You don't want to mix it.
Right. So you probably don't create, it's not uncommon for me to create a new center in my month-end process because something has changed and it would be inappropriate to just dump everything out. So I'll create more structure around distributing costs properly. But I like the routine and discipline of everything getting completely allocated out. Or I'll do journal entries, reversing journal entries or whatever that'll push the cost to the next one, something like that.
And I just want to make sure that we're close and we move on and I don't ever zero out. Any other questions?
On the, so like how you're doing it with your Center 35.
Yep.
So if we would want to start that, can we go back and read it out?
Yeah.
And where it'll push that?
Yep. So it should reverse all the original entries to Center 0 and then repost to Center 35.
Any other downside?
Back up first. Now, I don't foresee, I mean, if nothing's changed, all that WIP should recalculate the same dollar amount, just be to a different, posting to a different center.
Different division.
But, different divisions, sorry. Yeah, exactly. Anything else?
If you have division 35 or whatever, also, you can run reports and make sure that you're not, that whole division zeroes out.
Right.
You can run a trial balance by that. And that, to me, I love to see the control of, Norm didn't do anything weird in my system.
So we're going to take a short 5-minute break and present to the next session.